What to consider when thinking about locking in a fixed rate on your current variable rate mortgage. Let's say you are 2 years into a 5-year variable rate mortgage. You've been hearing about the possibility of interest rates rising in the future and are wondering if it makes sense to lock into a fixed rate mortgage now. Here are your two main options. 1. You can stay with your current lender and lock in a fixed rate with them. You won't have to pay a mortgage break fee, but the fixed rates they offer may not be as competitive as other fixed rates available in the marketplace. This is specifically because they know you'll have to factor in the cost of a break fee in your calculations if you switch to another lender. You'll also have to choose a term that is at least as long as the time remaining in your current term. So if you have 3 years remaining in your current term, you'll have to look at fixed rates for 3 years or longer. Option 2. You can switch to a different lender. You'll likely pay a mortgage break fee, but you'll be free to shop around for the most competitive mortgage rates. Switching is different from refinancing. A switch is when you transfer your mortgage to another lender with the same mortgage balance and same amortization. If you want to change either of these, then it's a refinance and it's a bit more involved. Let's take a look at a sample calculation starting with staying at your own lender. Here's your hypothetical current situation. Let's assume you have 18 years left on your mortgage, so your amortization is 18 years. The current mortgage balance is $400,000. You're currently paying a variable rate of prime minus 0.5%, and as of the production of this video, prime is 3.2%, so subtracting 0.5% gives us your current interest rate of 2.7%. Based on that, your monthly payment would currently be $2,337. If you stayed with your own lender, maybe the best fixed rate they will offer for the next 3-year term is 3.24%. That puts your payment up to $2,442 per month. Now, this is higher than what you're paying now with your current variable rate, but you are willing to pay a bit more in exchange for knowing that your payment will not increase for the balance of your term. And that's the trade-off people are considering when looking to convert from their current variable rate to locking in a fixed rate. If you shopped around to a new lender, perhaps you find a fixed rate of 2.94%. Your new monthly mortgage payment would be $2,384. Now, which fixed rate is better? This is where factoring in the break fee is critical to the analysis. Let's add up the total payments over the next 3 years for each scenario. Staying with our current lender, with the uncompetitive rate, we take $2,442 times 36 months, which equals $87,912. Switching to a new lender with a competitive rate, we take $2,384 times 36 months, which equals $85,824. But we also have to pay the mortgage break fee from our current lender. Because we have a variable rate mortgage, it will likely be equal to 3 months interest. So we take the current mortgage balance, $400,000, and multiply by our current rate of 2.7%, which gives us $10,800 of interest per year, and then we simply divide by 4 to get the amount of interest for 3 months. This works out to $2,700. If we take this $2,700 mortgage break fee and add it to the $85,824, we get $88,524. This is greater than the total cost of $87,912 we incur by staying with our current lender who is offering a less competitive fixed rate but no break fee. As a final note, it might be worth talking with a mortgage broker if you want to crunch your own numbers or want to consider other variables. For example, it's possible to come out ahead by switching to a new lender and getting a better variable rate. If you currently have a variable rate of prime minus 0.2% and you can find a lender offering prime minus 0.9%, that might be worth considering as well.